Bismillahirrahmanirrahim. This is the second video on accounting quality, and in this video we will solve an exercise on adjusting for unusual income statement and classification items. So we have a very comprehensive exercise over here. There is a businessman, Henry Company is a marketer for branded food to retail and food service channels. We have the income statement over here. There are some additional information, and the first thing that they require is to discuss whether you would adjust for each of the following items when using earnings to forecast the future profitability of Henry. The gain on sale of a portion of the branded product line. Now, the gain on sale of the branded product line is part number one, and then this is for the extraordinary loss. This we are going to look into the other relevant part of the question to follow. So, what I am going to do is that I am going to include only the portion of the question that is directly relevant in order to allocate more space for a clear and thorough explanation of the answer. So you can see that there is a gain on sale of a portion of the branded product line in the year number 10. Henry completed the sale of the portion of one of its branded product lines for 735 million. The transaction resulted in a pre-tax gain. The sale did not qualify as a discontinued operation. Henry did not disclose the tax effect of the gain reported in the exhibit, and the tax rates are 35 to be followed. So I just repeat again. The question is that there is a gain on sale of a portion of the branded product line, and should we adjust this gain when forecasting the future profitability? And the answer is yes, we should adjust for it. And the reason is that the gain of 464.5 million pre-tax is reported in the year number 10. Now, this is a non-recurring item, meaning it is not part of Henry's core ongoing operations. It resulted from the sale of a portion of the branded product line, which is a one-time event. So these type of transactions, they don't typically recur on a regular basis and are not indicative of the company's operating performance going forward. So even though it was included in the net income and not classified as a discontinued for operations, for forecasting purposes, we are primarily concerned with sustainable operating earnings. I repeat again, for not for forecasting purposes, we are primarily concerned with sustainable operation earnings or operating earnings. So we are going to exclude this gain when forecasting the future earning. So we will adjust the pre-tax income downward by 464.5 million for the year number 10. So we are going to subtract the 464.5 million, and we will adjust the net income downward accounting for the tax impact as well. Now, since the company didn't disclose the tax effect, we will apply the statutory tax rate, that is 35%. So 464.5 million times 1 minus 0.35, this is equal to 301.925 million. So for forecasting purposes, we would adjust the year 10 net income by 301.925 million. So to conclude, we must adjust for it because it is a non-recurring, non-operating and not predictive of future performance. So we will subtract 464.5 million. We can subtract this amount either from the income before taxes, or we can subtract 301.925 from the after tax. Either way we can do that. Okay, so we move on to the second part, and here they say there is a extraordinary loss. That is, we have to discuss whether we should adjust for the extraordinary loss when using earnings to forecast future profitability. And once again, I have simply focused only on the relevant section, that is extraordinary loss. The rest of it I have deleted just to have some space to explain the question. Now, so the question is, should we adjust this loss when forecasting Henry's future profitability? And the answer is yes, we should do it. And the reason is that in the year number 11, Henry recorded an extraordinary loss of 17 million after tax due to the expropriation of a subsidiary during a military coup, an unusual and infrequent event. So, even though it was labeled as extraordinary under current accounting standards, that is US, GAAP, and IFRS, extraordinary item classification is no longer permitted. So instead, such losses are now reported as a part of income from continuing operation. But from a forecasting perspectives, what really matters is whether the loss is non-recurring, whether it is not related to the core operations of the business. It is unlikely to repeat in the future. It is unlikely to repeat in the future. So this loss meets all the three criteria. It is a non-recurring, it is not related to the core operations, and it is unlikely to repeat in the future. So political expropriation is rare and not something that reflects the ongoing performance of Henry's branded food businesses. So, because the 17 million loss is already net of tax, you can directly add back this amount to year 11's net income. Uh, we can add it directly over here to get a better picture of the sustainable profitability. So the adjusted net income for the year number 11 will be 478 plus 17 million, that is equal to 495 million, which matches the income before extraordinary items. So to conclude, we must adjust the extraordinary loss because it is infrequent, non-operating, and not predictive of future performance. We are going to add back the 17 million after tax to year number 11's net income. So let us wrap up both the parts of the question. First of all, discuss whether you would adjust for each of the following items when using earnings to forecast the future profitability, and indicate the adjustment you would make to Henry's net income for each item in the requirement number A. Now, we have seen, or rather, we have discussed that the gain on sale of a portion of the branded product line needs to be adjusted, and we have adjusted it because this is a one time non-operating gain and not indicative of future performance. So there was a pre-tax gain of 464.5 million, and the tax effect was 35%. So that was so the tax effect actually will be, if you multiply 35% of 464.5 million times 464.5 million, this will be equal to 162.575 million. So the after tax gain will be 464.5 million minus 162.575 million. So this is equal to 301.925 million. So we must subtract 301.925 million from the year 10 net income when forecasting. Coming to the extraordinary loss, yes, we have to must adjust this also, as this was highly unusual, infrequent loss not expected to recur. So we have already reported a net of tax as a 17 million loss, and this should be added back as 17 million to year number 11 net income when forecasting. So to summarize, what we have done so far is, for the year 2010, there is a gain on sale, and to adjust this we have subtracted 301.93 million, and the net effect is that the net income is going to go down. For the year 2011, there is an extraordinary loss, and we have added back 17 million, and this is going to increase the profit net income for the year 2011. For the year number 12, there is no reclassification, so there is no adjustments over here. We move on to the part C now, and that is discuss whether you believe the reclassification adjustment made by Henry for the sale and promotion incentive cost, item number 3, are inappropriate. So once again, you can see I have deleted part number 1 and 2, and we have only part number 3 for answering this question. And as you can see, this is related to sale and promotion cost. In the year 11, Henry changed the classification of certain sale and promotion incentives provided to customers and consumers. In the past, that means we are talking of now of 11, so that means in the year number 10, Henry classified these incentives as selling and administrative expenses, and as we can see over here, we have we have put the gain on sale of branded product line for the year number 10. With the gross amount of revenue associated with the incentives reported in sales beginning in year number 11, Henry changed to reporting the incentives as a reduction of revenues. As a result of this change, the firm reduced reported revenues by 693 million in year number 10 and 12, and 610 in year number 11 and 464 million in year number 10. The firm stated that the selling and administrative expenses were correspondingly reduced such that net earnings were not affected. Exhibit already reflect the adjustments, so we are not going to make these adjustments to sales revenue and selling and administrative expenses for the year 10 through 12. So they have already made these adjustments. Now the question is, discuss whether you believe the reclassification adjustment made by Henry for the sale and promotion incentive cost, item number 3, are appropriate. Now in year number 11, as 1 minute. It is in year number 11 that Henry has changed the accounts for sale and promotion incentives. Before the year number 11, they have reported the gross sales revenue and they have treated promotion incentives as selling and administrative expenses. Now, in the year number 11 and year number 12, they reduce the sales revenue by the value of the incentives and correspondingly reduces selling and administrative expenses. Net income remains the same. That is what they have already explained in this statement over here. So, Henry incentives were likely not to be distinct services, but instead incentives tied to the product sales. So therefore, they reduce the amount of revenue Henry ultimately earns from the transaction. So I think okay, well, like when Henry reclassification should is Henry's reclassification appropriate? So for those who know ASC 606 and IFRS 15, in either case, incentives that are paid to the customers, they reduce the amount of revenue and it is not treated as expenses. So this reflects net revenue actually earned from sales, aligning better with economic reality. So to conclude, yes, the reclassification is appropriate. It aligns with the current revenue recognition standards under both US GAAP and IFRS. It provides a clearer picture of economic transactions and does not distort the net income. Okay, man. Uh, we move on to part D, and in part D, they say prepare a common size income statement for the year number 10, 11, and 12 using the amounts in exhibit. We have to set sales equal to 100%. So all we need to do is we are going to treat, so for the sales, for the sale, I can explain you for one year number 12, we have the sales of 9431. 9431 divided by 9431 and times 100, that is equal to 100%. Similar is the case for year number 11 and year number 10. It is we just simply because we have to take sales equal to 100. So that is now the rest is as a percentage of sales that where we are going to calculate for the common size statements. So gain on sale here it is already 0. Since year already this is 0 and 0, so obviously 0 divided by sales will give you 0 percentage, and for the year number 10 it will be 465 by the sales of year 10, that is 8939. So that is how we are going to get this value. Now this is cost of goods sold, that's why this is in negative, and again divided by sales because everything has to be denominated in terms of sales. So all these values or have been used to get these common size values over here, and then for the income before income taxes we have simply added up these values, that is what we get. And then for the income tax expenses, now you can see for the year number 12 we have uh, minus 445 divided by 9431, the sales times 100. So the income this is equal to minus 4.70. So for year number 11 it will be minus 2 and so on and so forth. And then we have added up these two, so that gives us 8.9, 5.6, and 10. Similar is the case with the extraordinary loss. 0 divided by the sales of year number 12 is 0. Here we have minus 17 divided by the sales 8821, it is minus 0.2, and finally we have simply added up these two values. So that is 8.8%, 5.4, and 9.9. Now there may be minor differences may appear because we may be rounding some of these values, but they will be very close to these numbers that are you see on the screen. Okay, now we move on to part E. And in part E, they say repeat the requirement number D after making the income statement adjustments in requirement B. Now, to repeat the common size income statement, with this time we have to adjust the net income figures based on the adjustments that we have done in before for the gain on sale. It was two. One was the gain on the sale of a portion of the branded product, and the second was the extraordinary loss. So we are going to put those values over here, and let me explain you how we do that. Now, in the year 2010, there was gain on sale of branded product line, and if you can remember, we have subtracted 301.93 million for that effect. Then there was an extraordinary loss for the year 2011, and that was added back as such. Then for the sale and promotion cost reclassification, there is no change, so we have not made any adjustments. So 890 is what we have as net income for the year 10, and from this we are going to subtract 301.93 million. So this will be equal to 588.07 million. Then for the year 2011, we are going to add back 17 million, and now this value is going to be how much? This is going to be 495, and there is no change in the year number 12, so it remains the same, 834 million. So now once we go for the common size statement, again it is 9431 sales divided by sales, and that is going to give us 100% over here. Then the rest of these values are in the terms of of sales. So obviously 0 divided by the sales, this gives us 0, 0 divided by sales, and then 465 divided by 8939, that will give you 5.2%. Similarly, we will calculate the cost of sales, cost of goods sold divided by sales, and we are going to get these values over here. So that's how we are going to get all these values, except I would like to emphasize on adjusted net income for the year number 10. Now here you see for the net in now the after the adjustment, the net income is 588. So we are going to divide 588 by the sales of 2010, and that's how we will get 6.58. So what you can see that after removing the non-recurring gain that we have removed over here by 301 million, Henry's profitability in the year drops. If you can remember, let me show you here, the net income was 9.9%. It has dropped to 6.58%. Now in the year number 11, the net income now has increased by 17 million. It is 495 million. and that's why the net income has increased from 5.4 to 5.61. For the year number 12, obviously it is 8.8 and it is 8.8 again, because there is no change in the net income. It is the same as we have seen. Okay. Next, they say assess the change in the profitability of Henry during the 3-year period. Now, to assess Henry's company's profitability trends over the 3 years, we will analyze the key metrics based on both reported and adjusted data, considering one time items and operational performance. Now, let us start with the reported net income. Now, net income, if you can remember, was how much? It was uh, 890, 478, and 834, and the sales was 9431, 8821, and 8939. Sorry, for the year yes, 8939. So if we calculate the net income margin for the year 2010, it will be 9.96%. For the year number for the year number 2011, it will be once again the net income divided by sales, that is 478 divided by 8821, and that is equal to 5.42%. And for the year 2012, it is 834 divided by 9431, that will be equal to 8.84%. So what we can observe that year number 10 shows a high profit margin, and this is largely influenced by the non-recurring gain of 465 million that we have explained in the beginning. Now, in the year 2011, the profit has dropped to 5.42, and this is driven by operational decline. If you can remember, there was a extraordinary loss of 17 million. In the year number 12, it reflects a recovery, a strong recovery, I should say, and the recovery with profit margin almost back to year number 10. Almost, you see 8.84, and that is 9.96. But this time it is driven by core operations. They are not including the non-recurring gains. So, for the year 2010, let me for the year 2010, we had the income of 890. For the year 2011, it was 478, and 2012 it was 834. We made the adjustment by decreasing this net income by 301.93 million. We added here 17 million, and there was no change over here. So the adjusted net income was for the year 2010, it was 588.07, 495, and there was no change, that is 834. And if you can remember, we have calculated these percentages as 6.58, 5.61, and 8.84% respectively. So when adjusting for unusual items in the year number 10, profitability is close to 6.6. You can see over here, it is 6.6, indicating the reported margin was inflated by the asset sale, as we have shown before. In the year number 11, that is the weakest year, you can see 5.61. Even with the adjustment, you see we have made the adjust, we have added back 17 million. But in the year number 12, it shows clear operational improvement 8.84 with the this is the highest adjusted margin. So if we look into the key profit drivers, uh, if you look into the sales, relatively it is flat in the year number 10 and 11, and then it rose significantly in the year number 12. The cost of goods sold as percentage of sales, it dropped from 66.7 percent in the year number 11 to 64.62 in the year number 12. So obviously this is going to improve the margins. Looking at the selling and administrative expenses, they have improved in the year number 12, 18.5% of sales versus just see it was 22.16 in the year number 11, and this suggests that there was better control in the year 2012. Then coming to the operating profit, you can see that in the year it doubled in the year from 673 million in the year number 11. It was to 1279 million. You can see over here it has almost doubled in the year, and that obviously this is a clear operational turnaround. So to conclude, there was a strong headline performance, but it was boosted by one-time gain, and true operational profit was more modest. It was just 6.58. In the year number 11, that was the weakest year. It was impacted by the foreign expropriation, high administrative cost, and stagnant sales, as you can see over here. Um, then in the year 2012, the company has recovered. There is a marked operational recovery with real profitability gains that has substantially improved to 8.84%. So overall, we can see that the Henry Company's profitability became more sustainable and operationally driven by the year 12 after a dip in the year 2011 and a one-time boost in the year 10. So we hope that we are able to explain adjusting for unusual income statement and classification with the help of an example. This completes the video on adjusting for unusual income statement and classification. We hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Thank you so much and happy learning.